Ladies and gentlemen, welcome to part 10 of our webinar series here. I'm very, very pleased to have Graham Keeler on the line with me tonight from Rev Royalty Income and Growth Trust. All the way from Penticton. Graham, how are you doing?
I'm actually awesome tonight. I'm very excited to be on the call and hoping for some spring weather one day in the Okanagan that we haven't yet had.
Yeah, you know, it's they always say sunny Okanagan, but at least you're not raining. I mean, we're got pouring rain here. Got a slight reprieve from the rain here in Vancouver. So listen, let's jump right into this. First of all, thanks for being on the call tonight, and for everybody listening, and if you're listening to this either live or on a recording, Graham is the Vice President Business Development with Accilent Capital Management. And tonight we're going to be talking about Rev Royalty Income and Growth Trust. So first and foremost, just a quick introduction to the concept here. Again, if you're brand new to the webinar series, my name is Peter Kinch. What I like to do in these webinar series is touch base on three different forms of investment capital. One is real estate, one is private equity, and one being the public markets, stocks and bonds. It's my firm belief that all Canadians should be well diversified into three different asset classes, some direct hands-on real estate ownership, some obviously exposure to the public markets. But the one area that probably is the least, how should I say, I think people are the least amount informed on is private equity. So tonight we're going to be focusing on private equity as an asset class, but within private equity we're going to pick one product, and that is Rev Royalty. Rev Royalty Income and Growth Trust. So we have Graham on the line here with us to tell us more about, what Rev Royalty is. So Graham, if I could ask you in 2 sentences or less, give me a quick 3,000-foot view of what is Rev Royalty.
Sure. Well, Rev Royalty is, the structure of Rev Royalty is just a common mutual fund trust structure, and really what it is, it's a fund of funds targeting 8% return annually to investors, or better said, maybe it's a fund of non-correlating asset classes. So it's just a fund of various funds.
Excellent. Okay, we're going to circle back to that. Explain one, what fund of funds means, what a mutual fund trust is, and also what non-correlating asset classes. We'll touch base on that. But whenever you're talking about private equity, we have to also have a disclaimer. So it's very important. And just to clarify, can you see the screen there, Graham? I just want to make sure that everybody's on the same page. You can see I've now got the general disclaimers on the screen.
Yeah, we've got it.
Excellent. Okay, so again, this presentation is Graham and myself. We're going to be talking about Accilent Capital and in particular Rev Royalty Income Trust Fund. But it's very important to know that this presentation or this webinar is for information purposes only. Is not permit. We got to be careful that any forward-looking statements are speculative in nature, and we want to. This is more for education purposes as opposed to sales purposes. If anybody is interested in investing in anything that we talk about here tonight, it's important that you go through a complete due diligence process. Sit down with myself so that we can get to do the know your client process and make sure that even if you love what we're talking about, we got to make sure that it's suitable for you and applicable in your personal financial situation. So again, just a general disclaimer to let you know that this is for informational purposes only. Graham, anything else that I missed there, or anything you want to add to the general disclaimer?
No, I think that's got it. Just the main fact that this is just a presentation for information purposes only.
How can you tell that the Securities Commission likes us to say that up front? Anyways, there you go. We've covered our legal obligation there. Okay, so before we jump into this, and we're going to talk about Accilent Capital, Graham, I want to find out a little bit about yourself. You're the Vice President of Business Development of Accilent Capital. How did you end up maybe tell us a little bit about yourself, your background, and how you ended up in this space, specifically private equity, and then within private equity, working with Accilent Capital?
Sure. Yeah, it's well, I'm a middle-aged 60-year-old So I've got a bit of a diverse background. My initial, well, really 20 years or so, I resided in Edmonton, Alberta, and was in real estate. I was a licensed realtor for most of that period, and ended up really working in real estate on investment type real estate, residential and commercial investment. So I started to get into that's the private equity world. And and around the same, so I started really understanding private capital and private equity, and what investors were looking for. And around the same time, just as kind of not an offshoot of real estate, but just as an offshoot of my own personal experience, I founded a gold and silver bullion company called Mountain Bullion Services. And
really?
Yeah, and I got a little bit deeper into into private equity and resources, and specifically hard assets. In this case, real estate and bullion. Yeah, and bullion. And in fact, that's at that time, years ago, is where I first met the founder of Accilent Capital. He reached out to me through my bullion services, and we formed a bit of a relationship. But I continued where I was, and moved up, if you will, to working with one of the largest international land investment companies, and became a senior account manager there. And that just kept immersing me in private equity and my understanding of it. And Accilent Capital reached out to me a number of years ago and asked if I would come and work with them. And I've been with Accilent for 7 years now.
Oh, fantastic! So one of the things that's really important is to I'm going to skip forward here to talking about Dan Pembleton, because I think obviously Dan's the founder of Accilent Capital, so it's important to understand Accilent. You got to kind of know a little bit about Dan. Is that correct?
Yeah, and I think it's critical for people to know who runs a ship. Quite frankly, I think it's the most critical factor in investing, and sometimes a little bit taken for granted. But yeah, Dan Pembleton is the founder and president of Accilent Capital, and Accilent is just a boutique. We're a boutique private equity firm located in the financial district downtown Toronto, and Dan has been working in the field, in the financial industry, since he graduated with his MBA about 25 years ago. He's got a lot of institutional background. It wasn't always private equity, but he started out as a floor trader on the Montreal Commodity Exchange, believe it or not, and that was back in the day when the exchange still had floor traders running around yelling and screaming and selling millions of shares with chits. So it was very exciting for a young guy that just graduated. But when the joy kind of went out of that, when it went computerized, Dan moved on to Dominion Securities, which is now Royal Bank or RBC.
RBC,
yeah, RBC Dominion Securities, where he became one of the youngest vice presidents ever there, actually, of their global money market fund. Dan ran about a $3.5 billion global money market fund. So a lot of institutional background and large trading. Dan is a portfolio manager. He's also an investment fund manager, and significantly, he's a commodity trading manager, or CTM, as well. So, and he's a CFA. So he's got a lot of background and a lot of experience.
So is it safe to say he's taken these 25 years of experience of being a portfolio manager, working for the RBCs of the world, and saying, wait a second, I can create my own company, and I have a really good handle on some niche areas I'd like to focus on?
Well, that's a really good way to put it. That is, Dan would tell you that's exactly where things came to fruition. After working in the institutional area for many years, he did get a little exposure to private equity and really found it interesting. And quite frankly, he felt that he wanted to create investment products in Canada and manage them himself, for himself and investors directly, not for the larger institutions.
Mm-hmm. You know, I think I feel the need to kind of throw out there, we throw bandy about the word private equity, and not everybody understands what private equity is as an asset class, because we all know about the stocks and bonds. When you talk about being a portfolio manager or an investment fund manager at RBC or Scotia McLeod or Wood Gundy, I think it's also important for everybody on the call to understand that when we talk about private equity, these are companies and products that are not traded on an exchange. We talk about the exempt market. The exempt market means that products are exempt from having a prospectus. In other words, they don't have a prospectus for the purpose of trading on a specific stock exchange. But excuse me, Graham, one of the words you used earlier, terms rather, of why people gravitate towards the private equity, and Dan in particular, is this concept of non-correlating assets. Can you touch on that and explain what you mean by a non-correlating asset?
Yeah, and sometimes, and I apologize for that, we're sometimes immersed in our own world and throw acronyms out there. But non-correlating in private equity simply means products or investments that don't directly correlate or mimic the public markets, like the TSX, for example. They don't follow that. They're really individual deals that work and run on their own merits.
Yeah, and the beauty of that is, and the importance to you as an investor, listening to this, is that, let's say, for example, and by the way, Graham, correct me if I'm wrong. I'm going to throw this statistic out, but this is not scientifically proven. This is my own. I'm inventing these statistics. They say people invent statistics are correct 50% of the time. But I believe that I wouldn't be surprised if 95% of Canadians have 100% of their registered funds, that's TFSAs and mutual funds, are 100% correlated to the stock market. In other words, they give that money to a financial planner, advisor, somebody at the bank, and your RSPs and your TFSAs are invested in something that's directly connected to the stock market.
Yeah, and actually I did specifically read an article recently that basically backs up your guesstimations there.
Yeah. So in other words, when you go down to your bank and you open up an RSP account, and they say, well, what are we going to invest in? You hand your money to the bank, and they put that into a mutual fund. And it doesn't mean the mutual funds are bad, or it doesn't mean the stock market's bad. It just means that if all of your RSPs are directly connected or invested into mutual funds, and the stock market were to correct or crash, and oh, by the way, we're in the 8th year of a bull run right now. So I know a lot of people sometimes say to me, well, I'm actually really pleased with my financial advisor because we got great results last year. Well, I would hope so. It's been a bull market, and after the Trump election, everything's gone up. But, I mean, and we can touch on this briefly, Graham, because I know this could be a sidebar conversation that could be an hour in itself. But, really, when something's in its 8th year of a run, and which is the second longest bull market run in history, logic would suggest that there should probably be a correction along the way, and it wouldn't take much. I'm going to say I wouldn't take anything short of a bizarre action from President Trump to trigger some sort of correction. Wouldn't you say that?
Well, I think that's absolutely correct, and just to kind of come back on that note to Accilent Capital and Dan and his experience in particular as the president of the company and a portfolio manager, he's been doing this long enough that he's actually managed funds and been an institutional trader and priced debt and credit through all kinds of downturns, referendums, recessions that you're talking about, like the Asian credit crisis, the Russian debt default, long-term capital management bankruptcies, et cetera, et cetera. So, we're dealing with somebody that knows where those unexpected risks can hide.
Yeah, so the reason why I want to touch on this is I just want everybody on the call to understand when we're talking about Accilent Capital, we're talking about a particular product. And within Accilent Capital, of course, Accilent has a wide variety of family of funds and services. Tonight, we're going to specifically drill down and talk about Rev Royalty, which is one of the products that Dan runs, one of the funds, rather, that Dan runs. And and Graham's going to be talking about that tonight. I just want to help everybody understand the context here. When we're talking about the potential to look at this as a potential investment for yourself, that would be a private equity investment. And the reason you want private equity is so that you have a percentage of your liquid assets invested into something that's not directly correlated to the stock market, so that if the stock market were to have a correction or an adjustment or even a crash, yes, anything that's connected to that stock market will adjust accordingly, but everything that's private equity basically stands on its own. Thus the term non-correlating. So Graham, on that note, that kind of gives us a segue to talk specifically about Rev Royalty. So, okay, the name suggests royalty, but I know there's more to it. You mentioned this is a fund of funds. Maybe tell us a little bit about it.
Yeah, so it's Rev Royalty is, I talk about it being a fund of funds, but it's in effect a fund of asset classes, if you will. We use fund of funds kind of more as a street term, but Rev Royalty is a a non or really low correlated, very diversified portfolio of assets that yields monthly distributions to investors, which is yield, and still targets a bit of growth or capital growth over time as well. And the reason for Rev Royalty, or where this started a few years ago as a thought process with Dan Pembleton and myself, was that we're all aware that the low interest rate, you spoke of interest rates earlier, and the fact they're likely not going anywhere too soon in the upward direction, but this low interest rate environment and really horrendous expanded money supply have really squeezed a lot of investors out of what we would consider traditional investments or traditional savings vehicles like bonds and GICs. The yields are quite frankly just too low. So we wanted to devise a diversified portfolio of a little bit more niche market asset classes, if you will, or niche market areas that could create better yield and still be somewhat in the moderate risk area. So what Rev does in a nutshell is it's really a lending vehicle for the most part, and Rev Royalty provides lending to what we would call outside preferred originators or other contracts, and directly ourselves, especially in the royalty area. So the fund, again, just it creates monthly distributions of yield to investors while targeting growth. And this diversified portfolio, and we'll talk a little bit more about that here in a minute, the diversification in the asset classes, but this diversified pool, if you will, this concept really creates more stable distributions that, as you mentioned, aren't directly correlated to the to equity market returns.
So hypothetical, so I'm an investor. I'll use an example. I'm an investor and I've got X dollars that's currently in my RSP or TFSA, and I'm looking at what I'm getting in the bonds or GICs, and I don't want to be too risky, but I'm just really not impressed with the returns I'm getting in my RSPs. You guys are targeting an 8% return. That is appealing. So myself and others would put money into, if we invested X dollars into this fund, that would be pooled with other investors' capital. And then you guys basically take that bucket of money, that pool, and then you diversify that by investing that capital into a variety of different types of investments.
That's correct, and it's somewhat similar to I mentioned at the beginning that our structure is really a common mutual fund trust structure, and we're not a mutual fund as people would think of a mutual fund necessarily, but it's similar. This is a mutual fund of various assets. The real differentiation is that rather than what people are more used to, I think, and especially with the traditional banks and their RSPs and TFSAs, is when they open their accounts at those large institutions, they're typically put into mutual funds that hold
Which indirectly the mutual fund is going out and buying a whole series of different stocks and bonds.
Well, and that's what I was going to say. I mean, those mutual funds are well, they're 100% in the public markets. So they are at the whim. And, you know, just as a bit of an aside, over the years, when I've talked about diversification, it's been very interesting. When I talk with investors, clients, the public about diversification, I sometimes get feedback that, you know, somebody will stand up and say, well, I'm already very, very diversified. I have 10 different mutual funds. Well, the fact is that that's not really diversification. Those mutual funds will hold different stocks and bonds potentially in them, and likely do, but they're still all correlated to the public markets. What I'm talking about when I use the word diversification and asset allocation is true allocation in totally different asset classes, not in one area like the public market. So really we're a fund or a mutual fund trust. Similar in a way to the traditional mutual funds, except we hold these private deals or private equity contracts within our fund that don't go up and down at the whim of the markets. So similar but very different.
Well, it's what makes it different that's very important. I couldn't help but chuckle to think of a bar in Kamloops that said, yeah, we got both kinds of music, country and Western. You know, so that's kind of how you would describe diversification in the mutual fund world.
Yeah.
But, you know, it's very important to understand that, I think. And, you know, the reality is a lot of financial planners just don't. I think this is something where a lot of people are confused, or not confused, but saying, well, if this is such an important thing to diversify outside of the public markets, well, why hasn't my financial planner suggested this?
Is that a question?
Yeah.
Yeah. Well, it's a great comment, and as a question, why doesn't the public know more about private equity? I really believe that the main reason is the large institutions marketing over the years, and they've done a great job of that, of bringing people into their retail institutions. I'm talking about the chartered banks, and quite frankly, keeping people somewhat in the dark, and investing their money in the public market in mutual funds. They don't talk about private equity.
It's kind of like it's a machine. And by the way, I'm not trying to critique the mutual fund industry or the or be cynical about it, but the reality is, well, let's be honest. Your typical financial planner is not compensated if he recommends something outside of what the bank. But their commissions and their bonus structures and such are designed and around selling the bank product, and private equity is typically not part of that model, and I think that's a big part of it.
It is.
I kind of, the analogy I use is if you go to a general GP and ask them for an opinion, you're probably going to get a pharmaceutically based opinion in terms of a solution to your health problem. Very seldom that a medical doctor is going to recommend a naturopath. Right, so it's almost kind of different areas of expertise. But anyways, we could stretch that analogy too thin, I'm guessing. But let's get back to Rev Royalty specifically. I think we understand now that it's a fund of funds. It's going to target 8%. It's something you can invest, use your RSPs or TFSAs, or outside of that, you can put cash in there. So let's dive in and talk a little bit more of this fund of funds. What kind of asset classes does it target?
It's
and by the way, sorry, just quick homework thing. If anybody has a question, there is a question bar. Feel free to pop me a question, and I'll make sure that gets passed on to Graham. And Graham, if you want me to move ahead to any slides, just let me know.
Yeah, it just depends on. Do you want me to just talk specifically about what's in the fund right now?
Yeah, just let's dive into it and talk about how the fund it works and what kind of asset classes it targets.
Sure. Well, it's if you want, maybe we could move ahead a few slides to how we stand apart. It should
Okay.
be maybe 3 or 4 slides there. Just a couple more.
Yep, there you go.
No, one back, or two. No, you've gone too far, I think. Oh, one more. Sorry, I'm trying to remember my own presentation.
Gotcha.
Yeah, I think it's a good time to talk about. We've spent a lot of time discussing the fact that it's various asset classes, it's diversified, it's non-correlating, et cetera, et cetera. But very specifically, the Rev Royalty Fund is made up of 5 general asset classes, and in no particular order. They're on the screen, they're showing as general factoring and medical factoring, cloud services financing, plus traditional leasing opportunities out there, business and mining resource royalties, consumer credit, structured finance, and real estate. So those are very broad asset classes, but we're targeting quite specifically within those asset classes, and we're not necessarily in every asset class at any given time. This is a bit of a moving target, if you will, and only meaning that, as people are probably familiar, every asset class is not always the best place to be at all times. So we will, our portfolio manager and our team, our investment committee that surrounds our portfolio manager and helps, they will be strategically moving over time in and out of some of these asset classes. Now,
so it's safe to say that your offering memorandum would allow you the ability as a fund to invest in any of these 5 asset classes at any given time.
Yeah, that's exactly right. We have,
but it doesn't mean you're invested in all 5 asset classes all the time.
No, and that's simply just to reiterate, that's just a function of, quite frankly, not all credit classes are good at every given time. For as an example right now of an asset class that we currently don't have any capital invested in, it would be consumer credit, which is I think the fourth item on the screen. Now we may in the future, but we as a team, we just feel that in the current environment of heavy family and household debt loads in Canada, that this isn't maybe the time to expose capital to consumer credit. As we're all familiar, or we hear all the time, it really wouldn't take too much of a rise one day in interest rates to put a lot of stress on a lot of families. So we're very conscientious of that really on a macro level. So we're not in consumer credit today. Where we are invested in the fund at this point in time is in some general factoring deals, medical factoring, cloud services financing, and as well as some what I would call traditional leasing areas, meaning it could be equipment leasing, that type of thing. And we have already made our first investments in the royalty business. So, what I could talk about maybe is the next slide actually breaks down those 3 asset classes that we are in today.
Well, let's start with royalties.
Yeah, so royalties are...
the fund name is Rev Royalty, so obviously royalty is a big part of it. I think, and I know I got a question here about, giving us an example of a typical investor. If they put money into this fund, how would it be? What would you do with their money, type thing? So I know that was Eric asked that question, and so Eric, really, when you put your money into this fund, it is part of a larger pool. Your money's not directly invested in a specific royalty asset or something. It's invested in a pool, which then goes into investing in a variety of different areas. So one of the areas that you guys are going to be focused on is royalty opportunities. So let's talk about that for a second, Graham.
Yeah, and you're right. The fund is called Rev Royalty Income and Growth Trust, and it did start out a few years ago in the business thesis started out with royalties in mind, and it evolved into this multi-asset class product. But royalties, a lot of people aren't that familiar with royalties.
No, I wasn't, so that's a great thing to explain a little bit.
Yeah, and the fact is that it's I think people just need a brief explanation on royalties because they're very sought after by investors, first of all. But a royalty is a way for an investor to get exposure, direct exposure to a business's wealth creation, to their actual activities of creating revenues for them right at the revenue level without taking on the business's risk. And what I mean by that is royalties are the top tier pay. When we negotiate a royalty with a say a manufacturer or more specifically in the resource sector, it could be a mining royalty. The example I sometimes use is let's say it's a gold company. It's a gold mining company. They're pulling actual gold out of the ground, and for whatever reason they want to expand to the land next to them, or they want to buy more equipment to expand their business. They will often look for capital and give up royalty rights on the gold. And what happens is, the reason I say it's top tier pay and very, very sought after by investors is that a royalty is paid first. So specifically in a gold mine, for example, when the gold's pulled out of the ground, it goes off to be refined. The refiner actually pays when the gold is sold. The refiner actually pays the royalty first. So the royalty owner, which in this case would be Rev Royalty and our investors, get paid first. The rest of the money then goes back to the original business. So in a way, we really, although we certainly want that company to be successful, we're really not exposed to their business risk.
Right, you're getting that paid first, and as opposed to sharing in the profit.
That's exactly
which could be exposed. If you're sharing in the profit, you got to wait to go through all the risk to see if they actually make a profit.
Well, and you know, there are certainly ways for corporations to not maybe show profit. So we're kind of above that business risk. So the royalties get paid to us first, and you know, just a kind of an interesting thing. I didn't understand royalties a few years ago either, and but I have watched that Canadian show Dragon's Den for I think it's been on for 15 years or more now, and I've watched every episode ever made, I think. And one of the things that I didn't understand a few years ago was one of the panelists, the Dragons, Kevin O'Leary, who they call Mr. Wonderful. Why he always, when he was negotiating with an entrepreneur that came on the show and he liked their idea, why he always tried to negotiate a royalty. I didn't quite get that when all the rest of the panel were negotiating equity, trying to get equity in that company for a certain dollar. Kevin O'Leary always went for royalties. Now I understand why. He's a smart guy. He knew when if he could negotiate a royalty with that entrepreneur and whatever they were manufacturing, he was going to get paid first before they even got paid. So that's what a royalty is.
Well, and it's a good example of, you know, this is an asset class. Like a lot of people might say, okay, I understand the royalty, but how would I go out there and be able to purchase a royalty and put it into my RSP? It's a difficult thing for the average investor to access the ability to invest in royalties. So, and again, I want to emphasize that when you've got a fund of funds, and royalties is one component of it, it's like, well, now you've got some access to some royalty income. Now, well, give me one example of a royalty investment that you guys have made with Rev Royalty.
Sure. Well, there was recently, in the past, I'll say 6 weeks or so, we made an investment in actually an aggregate company, meaning gravel. So it's actually a gravel company or aggregate company that was very successful and looking to expand, and they needed some, you know, what we would call sort of mezzanine financing. The banks loaned them up to a certain amount of the financing they needed, and they needed more. So our investment committee identified that offer, and we spent quite a bit of time negotiating it. So. That's a direct example of a royalty. It's not always on a. People think of royalties sometimes on things like artwork and resource.
Records, songs.
Yeah, records. Yeah, exactly. And that could be a part of it, although we think those are a little bit riskier.
Yeah.
So we stick to general business royalties. But yeah, so we've actually invested in an aggregate company, and we get a little piece of everything they produce.
Right. So that's an example of a target that
Yeah.
you would find. A deal comes along, you say, hey, that makes a lot of sense. We're going to move into it. Let's move along to medical factoring and tell me a little bit about how that would get. I actually understand this niche. I worked with a company previously. We did some medical factoring, and once I got to understand it, I thought this is amazing. But explain this one to us, because I think this is a great example.
Yeah. What we're Now, maybe Peter, what you can do, because you've got a lot of experience with factoring as well. Maybe it'd be beneficial if you gave a really brief explanation of what factoring even is, and then I'll talk about medical in particular.
So for those of you who aren't familiar with it, factoring is where typically you might have a company that's going to receive an invoice. They've done the work, or they've provided a service to a supplier's provided a service to an end user, and that money is owed back to them. But maybe there's an invoice that's payable over 30 days. So the manufacturer is now waiting 30 to 90 days to 120 days to receive their money, but they need operating cash flow in the interim. So the factoring company comes in and says, listen, I'll give you 90 cents on the dollar or 85 cents on the dollar, and you get cash today in exchange. You basically buy the receivable. Would that be a great example?
Yeah, that's exactly it.
And the medical factoring, a great example would be, and this maybe I'll pass it off to you, but medical doctors, specifically in the States, regardless of what Trump ends up doing with the Obamacare, but a patient comes in, if they've got insurance, they'll have a procedure done. That doctor and or private hospital will have to wait 90 to 120 days to receive their income from the payment from the insurance company. So there's a way of guaranteeing that insurance is going to pay that bill, so the factoring company can come in and effectively purchase that receivable from the doctor and or the private hospital and say, listen, we'll give you 85 cents on the dollar today in exchange for that receivable from the insurance company. And the doctor says, hey, I'll take the cash today, thank you very much, move on. And then the fund can then receive the income from the insurance company. So that's traditional medical factoring.
Yeah, and that's really what this is, Peter. I mean, that's and it's as you're familiar, it's a huge business, and has been for many years, medical factoring, and especially in the U.S. The Obamacare legislation or Affordable Care Act from a few years ago. Really, medical factoring was done long before Obamacare, and it'll be done long after if there is no Obamacare or Affordable Care Act.
Well, even if that's absolved, there's still going to be some form of millions of people who are privately insured in the state. So
yeah, that's a fact. And the what the Obamacare legislation though did for medical factoring was it was a bit of a boost though in that area, because it added. You mentioned rightly so that these insurance receivables for the doctor, clinic, small hospital, they can wait 30, 60, 90 days from, say, Blue Cross, for example, to get paid. Well, the Obamacare legislation added another layer of legislation, another layer of bureaucracy on top of everything, and it, in fact, extended that out even a little bit further. So it created even more of a medical factoring industry. Because these doctors and clinics were starting to wait even a little bit longer to get paid. So now, and you are correct. All the contracts will vary slightly from deal to deal, but in general terms, the factoring company would pay that doctor or clinic maybe 85. It could be as high as 90% immediately in cash to take over that receivable. But they also then charge anywhere from 2 to 3% per month.
Right.
As well, interest. Now, you extrapolate that's 24 to 36% a year, which seems crazy, but it is worthwhile for a business to factor at those rates because it's short term. These are 30, 60, 90, 120-day contracts, and then they're revolved.
Well, I'll tell you something. This in particular, medical factoring in itself is a investment asset vehicle that there are some people out here, that's all they do. And I know a particular hedge fund that I was involved with previously, and they raise millions of dollars every month into medical factoring, and that's 100% of their portfolio. So there's a lot of people. It's one of those things that is not widely known. A lot of people aren't aware of it. Therefore, it's not something that's popular, if you will. But my goodness, one of the questions you and I talked about offline is people will often ask you, how do you guys end up being able to afford to pay 8% yields every month?
Mm-hmm.
And I guess one of the answers is, well, if you see the type of percentages that you can get through medical factoring, that'll tell you.
Yeah, and just as of note there, it's when we look at just to clarify, outside of the royalties, which we originate ourselves, Dan Pembleton, the portfolio manager, and our investment committee, we actually negotiate and do those contracts directly. But the factoring and leasing deals, quite frankly, we're not absolutely the experts in every field. So we use what's called third-party originators. So our investment committee brought to us the top couple of U.S. medical factoring companies. So we're investing alongside them. So they're an originator. So when we talk about 2 to 3% a month, for example, or 24 to 36% a year, we certainly don't get all of that at Accilent Capital. The originating factoring company in the U.S. would take their piece, and then we would get our piece. But our piece is still in the high teens.
Right, and these factoring companies are always looking for investment capital, whether it be from hedge funds or funds like yourselves.
Yeah, correct. So what we do at the thesis for Rev Royalty is that we only look, doesn't matter which asset class we're talking about in the fund, we really only look to identify and invest in assets that can generate a minimum of 12% return, internal return. So that gives us a little bit of a cushion to be very confident that we can pay out 8%.
Well, and again, I want to really re-emphasize this for everybody on the call, because you might sit there and go, wow, geez, I don't know, that seems a little on the risky side, this whole medical factor. I'm not sure I understand that. Again, what's important is we're not saying, first of all, you would never put all your money into private equity. You put a percentage of your capital into private equity so it's not correlated. Then within private equity, you pick a few different companies. And then one of those companies might be Rev Royalty. And then within Rev Royalty, you could have access to the royalty business, the medical factoring, and the next one we're going to talk about here is cloud services financing, because this is a whole nother area that I wasn't familiar with, but it's just one of these, by the way, I just find it really fascinating. There's all these little niches out there of ways people are making revenue and capital that is not widely known. But I like the fact you guys have a fund that's kind of has the ability to go out there and find these unique pockets of opportunities and kind of capture them and fold them into a fund.
Yeah, it's very interesting, and they are what we call niche opportunities, but I think people need to understand niche does not necessarily mean small. As we've mentioned, the royalties in general is a big thing worldwide. Medical factoring is a massive business, and cloud service financing in particular is an interesting one. I read somewhat recently in a Forbes magazine article that cloud service providers or cloud service contracts are one of the fastest growing areas in business worldwide right now. It's a big business that's getting massive, and again,
not surprising given the fact of how much is moving to the cloud.
Yeah,
in general, and that in itself is just an explosive industry.
Yeah, it's becoming massive, and it's also becoming more mainstream. I would say even 2 or 3 years ago, a lot of the public really didn't know what the really even what the word cloud meant when it came to computing and software, hardware. Now I think a lot of people are starting to, and for example, I'm a Mac computer type person. I've got a Mac on my desk I'm on right now. I've got a MacBook laptop. I've got an iPhone. I've got Apple TV. I like Mac. Well, I've been used to the cloud because Apple has for
iCloud.
years that's exactly it. They've got iCloud. That's just their cloud service. Now that's their own proprietary cloud service, but there's cloud services now out there by many large companies. So what really,
so okay, we understand the cloud service. How do we monetize that? How's that play into your fund?
Yeah, that's really good question. So that's what a cloud service provider is. So effectively how it gets monetized is, and maybe the best way to get at that is, well, I'll just pick this isn't a specific contract that we have or anything, but I'll just pick a company everybody knows, like Royal Bank, for example, which is just a large company. And small companies, individuals, and large institutions are now using cloud services. So the Royal Bank historically would have had somewhere in Canada, or in many locations in Canada, back rooms full of computers, or what are called servers. They're just big storage computers to store data and their software and everything, and they would run it internally. And to do that, they would have to put a capital outlay out for that equipment, and they would also have to put capital out every month for their IT staff to hire individuals to run all that for them. Well, what's been happening now, and slowly and now very quickly, is in this example Royal Bank will use, they're now starting to contract more and more of those services out to third-party providers, which are called cloud service providers. Mm-hmm. So the capital requirement has moved from the Royal Bank now over to that cloud service provider, that independent business out there, because
and these are growing massively. These cloud service providers,
yeah, they're not, you know, a lot of them start out small, but some of them get big in a hurry, quite big actually.
And when that happens, they have capital requirements.
Well, that's exactly it. So now when that cloud service provider, XYZ out there, company, gets a contract, let's say they get a 5-year contract with the Royal Bank to take over a great portion of their data storage and IT services and software and everything else. Now the capital requirement has shifted over to the cloud service provider. It's that company now that just got that big contract that might have to go out and buy more equipment, more servers, hire more IT staff to run it all. So the capital requirement has shifted from that traditional corporation over to the CSP, or cloud service provider. We're simply financing that cloud service provider.
Gotcha. Yeah, and again, as you say, their fees plus interest generally in the high teens, low 20s. This is what allows you guys, after all expenses and whatnot, to target an 8% return. And I think this is where I'm going to the next slide here and look at the structure of the fund. So again, just recapturing all this, whether it's royalties, medical factoring, or cloud service financing, those are 3 examples of areas that you guys have identified. I wouldn't say target, more Dan and the team have identified those as good investment opportunities, so that the fund is created so that it can go out there and invest into any one of those pockets or combination of those investment classes, and then creating yields in each one of those. Those yields are pooled together, flow through back to the investor as a return, and that's where you come up with the targeted return. Touch base on the profit sharing component.
Yeah, sure. Yeah, there's and it is correct. We've targeted an 8% annual return, which is yield or income.
Sorry, I'm speaking over you. For clarity, targeted doesn't mean guaranteed, folks.
Yeah, I was going to get to that, because we very specifically, of course, use target because nothing is guaranteed. You know, this is investing, but we're targeting 8% minimum return per annum, and we do pay the distributions monthly back to investors. There is, though, the potential for additional profit sharing. And the way that works is simply, once we have paid 8% in any given year back to our investors if in fact at the year end we've actually made a little more profit than that, or i.e. we could have paid more than the 8% because we did a little bit better, we performed better. Anything above the 8% paid back to investors is a what's called a performance fee. It's split 80% to the investor and 20% to the portfolio managers. So this is a true performance fee-based product. We're targeting 8%, but if we can perform better than that, and that's really, how our team makes their revenues is to outperform. If we can outperform, we pay a fee, an additional bonus, if you will, out on an annual basis to our investors, and it's an 80-20 split, 80% to the investor above 8%.
And by the way, that 8% target is net after fees. You see on the right side there, because the first thing a lot of people will say if they immediately compare this to a mutual fund, the one critique of mutual funds is the MERs, the management fees. It's a 2, 3, 4% fees on the back end, and it's diluting my return. And it's not unusual for a mutual fund or some portfolio managers to say, well, we got a 5% return, but that's not net after fees.
No, and yeah, I thank you for pointing that out, because when we talk about target returns, we're talking net to the investor always. And yes, there is a 2% total portfolio management fee on RevRoyalty, but really, quite frankly, the incentive for us as a group is not that management fee; it's to outperform.
Graham, give me one example. I know, just for time's sake, I want to move to wrapping up soon, but give me one example of a situation where you guys have been able to pay out profit sharing, or targeting a profit sharing.
It hasn't happened yet, and I'll tell you the reason why is this is a reasonably new fund in Canada. I mentioned earlier that we had been working on this, building the thesis for going back 3 years. The fund launched in Canada about 1 year ago. So it's really in its, if you will, it's just gone past, really it's in its first year. We've gathered, a few $1 million of assets and have lots of investments, but the first year there will be no performance paid out to investors or to the portfolio managers. That's just simply economies of scale. The first year it was not expected to, so we're really looking at potentially 2018, once the 2017 year end is done. Right,
which you're coming up on?
No, the 2017 year end. We just finished 2016.
Okay.
Yeah, we finished 2016, but the fund was really launched in early 2016, so there was no performance for anybody the first year. We paid the 8% target yield, but there was no performance. At the end, we'll be revisiting that, of course, in our audited financials at the end of 2017 year, and potentially paying out a bonus in the first quarter of 2018.
Excellent. And by the way, you'll notice that you got an 8% targeted return. If you are getting an 8% yield, one of the best vehicles for this is a TFSA. I can't emphasize enough, I think people have underutilized TFSAs. It's a tax-free compound. I mean, you can get 8% compounding tax-free. That's a significant benefit and a great way to utilize that TFSA, in my opinion.
Yeah, and also on that note, sorry, Peter, it's just on the compounding note, just as a reminder that RevRoyalty is dripable, so it can.
Okay, you're gonna have to explain that because not everybody understands what a drip is.
Yeah, it's we set it up with a drip, or DRIP, which stands for dividend reinvestment plan. So what that simply means is that if a client wishes to or doesn't need to receive the 8% target yield every year at this point in time, they can actually do it as a drip, meaning that instead of paying the returns on a monthly basis, our administration simply uses that return to effectively buy you more units. So you're just constantly getting more and more units in the fund.
Right, thus the compounding.
Thus the compounding, and you can do a drip program within your registered accounts, your RSP, TFSA, etc. And you can also, with Rev Royalty, in fact, on a non-registered, meaning a cash investment outside of your registered plan, for those that choose to do that, you can actually drip. You can drip or reinvest automatically with more units in cash as well.
Yeah, and the other thing that's important here, some people in their pensions, I know I work with a lot of clients where we get to the point where, you know what, maybe I've built up a large pool of capital in my real estate. I'm liquidating my real estate portfolio, but to supplement my pension, I need yield. And your typical mutual funds and that don't always produce yield. So, you know, for those of you looking for yield, in other words, money that you can go use and buy groceries at Safeway in your retirement, you know, something along this line or a combination of yield-based products are very helpful in that sense. Mm-hmm. Liquidity, touching on that just briefly, you know, if somebody needed their money back, I'm guessing that's that would be you got an annual redemption policy.
Yeah, and this a lot of private offerings, because of their nature, are somewhat illiquid, meaning that a lot of offerings, including some of our other offerings, are on a term basis, meaning that it's expected your money will be tied up for 5 years or 4 or 6, etc. They're somewhat illiquid. Rev Royalty is what's called an open-ended ongoing product. That means there is no specific term or endpoint. Right. For Rev Royalty, it's ongoing. This product will be ongoing for many, many years. So because of that, we built in liquidity options so that investors can redeem and cash out basically of the fund on an annual basis. So every year there's annual redemption options there, and at the end of the first 5 years of the investor's experience, there's no fee to get to redeem.
After 5 years. So the first 5 years of the DSC is deferred sales charge, service charge. So there's a schedule that's basically, if you want your money back after 1 year, here's the fee. Here's this, and as that progresses towards, by the time you're fully vested after 5 years, there's no fee. You can have your money out at no cost.
Correct.
Correct. One of the questions I've got here was, how much does it cost per unit? And does the cost per unit fluctuate similar to the stock market?
Yeah, that's actually a really good question. The units were set at originally at $1 per unit, and they do fluctuate slightly, but very, very little. It's actually not structured. It's not structured the same way as a traditional mutual fund where the unit prices vary all the time. Investors can expect to buy in at any given time for right around $1 a unit. Okay.
Yeah, it's not something you're getting equity appreciation on the unit.
No, you're not.
Yeah, yeah. So, Kim, to answer your question, like when you go into a traditional fund or you buy shares in a company, you buy it at X dollars. You might get a dividend, but really what you're trying to do is sell that when the cost of that, or the value of that share goes up, and then there's the profit. That's not how this works. It's really just the yield. Think of it as a flow through. It's the way a MIC works. Like the interest just kind of flows into the company. They take their fees, and what's left over flows through to the investor. Targeted 8% return. One of the other questions, is the 8% return guaranteed? No, no, no. This is, you know, there's risk involved with any investment. You know, so one of the things I wanted to touch on is let's touch on risk. I mean, let's face it, there's no such thing as a guaranteed investment. There's risks inherent with any type of investment, so it's important to really emphasize that. But, you know, Graham, let's just, come on, let's talk about what's your worst case scenario in this. I mean, you know, sure, I mean, theoretically, you could lose all your money in this fund. But give me some examples of what would have to happen in order for the fund to start losing money.
Yeah, and that is the question I think that people should ask on any investment. And yes, theoretically, any investment, including Rev Royalty, you could lose all your money. You know, there could be black swan events happen, I guess, but really, fundamentally, we see the risk with Rev, because of its diversification, being a bit more controlled risk, if you will, or a bit more managed risk. And what I mean by that is, even though some things are out of our control sometimes, as far as our risk is concerned, to a point, what we see as potential risk when we talk about it is, you know, maybe we'll just pick a contract. Maybe in cloud servicing, we've got a little bit of the capital into cloud servicing, and some of that little bit of capital is with one company A, cloud service provider A, and some of it's with cloud service provider B, two totally separate companies. And within each of those companies, we might have 1 or 2 or 5 or 100 contracts that are all independent. The risk that we see is that it's potential for a contract to go bad, and or one of those CSP the providers themselves to have a rough time.
Right.
So that,
anything can go wrong at any given time. Stuff happens. Right?
Absolutely.
And
so
same with the medical factoring. You could have any,
sure.
you know, but the insurance provider suddenly finds a loophole not to pay that claim.
That's never happened by an insurance provider, has it?
No, a very hypothetical scenario.
No, but you know, the fact is that you know, a contract could go bad, but what it would represent in the portfolio would be a small part of the entire portfolio. So we look at it and think, you know, there is potential for a Rev Royalty product, a multi-asset product, to have a weak yield potentially in any in some. Our yield we might not make our 8%. And I'm just using numbers here, of course, but throwing them out. But you know, it is possible that in any given year we might pay 5 or 6% because we had a problem in the portfolio. But the risk of losing entire capital, I think, is minimal. I think things would have to go bad in every asset class in North America at the same time.
Well, you know what, Kim had a good question here. What makes Rev Royalty stand out from other private equity vehicles? And if you don't mind, I'll answer this, and I'll let you answer it. But in my opinion, from what you've been talking about here, is that first and foremost, I'm going to repeat myself, you don't put all your money into private equity, you put a percentage. And that is so that it's not correlated to the stock market. But even within private equity, I recommend people diversify into different private equity vehicles. And if you choose Rev Royalty as one of those vehicles, Rev Royalty then has internally diversified into 3, if not eventually 5 different asset classes. In this particular case, we've covered off medical factoring, royalties, and cloud services financing. But in any one of those pockets, something could go south or sideways. And if all the money that they invested into the cloud servicing, for example, were just to blow up and somebody missed something and that money just didn't perform the way they thought it would, the fund doesn't go bankrupt. You don't lose all your money because that's one of the 3 asset classes that went south on them. So, but the fact is, you guys have also have what I would refer to as risk mitigation factors, and that's where Dan Pembleton, Accilent Capital, the history. Somebody might say, well, you guys have only been around a year. This is an unproven program. But I would also argue that Dan's track record of 25 years of being into as a portfolio manager in a variety of different asset classes, and Accilent Capital's track record is what you kind of have to really look at here in terms of what's why there could be some faith in the sense of what Rev Royalty's doing. That's my kind of stab or answer at that. Is there anything you'd like to add to that, Graham?
No, not too much. I mean, that is a fact. There's Accilent Capital is a multi-fund company. We're not always, but we're periodically going to be coming out with new funds, new business theses. Every one of them will be new when it's new. But the real test is in the management and our past history. this is not our first fund. In fact, it's about our 5th different business model. We've run consecutively, concurrently, and many funds in the private equity market. And actually, Accilent Capital is in its 50th year now. It was formed in 2002. Mm-hmm. I think Rev Royalty is in total about maybe our 16th OM in Canada.
Is that your first rodeo?
It's not our first rodeo, no. No.
Graham, this has been excellent. I've really enjoyed chatting with you tonight. I know we're coming up on the clock here. So, in wrapping up, is there anything in closing that you'd like to share that we haven't already covered off?
No, I think we've kind of got it all. We've talked about Accilent Capital and our long history, and quite a bit about our portfolio management, and we touched on the investment committee that surrounds Dan on Rev Royalty. Really just want to say thank you for the opportunity. And I know there's always questions that come up after the fact, and when people think about things, and we're here to help. We're here to answer.
Absolutely. Well, listen, Graham, again, thank you very much. That's Graham Keeler from Rev Royalty, part of Accilent Capital. A fund of funds starting an 8% yield that would be perfect, ideally suited, or potentially ideally suited for your RSP or TFSAs. Folks, again, I want to emphasize in closing, thank you very much, Graham. It was an absolute pleasure having you on the line here tonight. But for everybody else on the line, I just want to really emphasize that regardless of what we end up talking about in the private equity world, I think it all starts with your gap analysis. If you have not done a gap analysis with me, please send me an email, and I'd be more than happy. It's a free half-hour, 45-minute consultation that I offer to everybody on the line. And it's really, the gap analysis is designed to address where you are today, where you're going, where you see yourself down the line 5, 10, 15, 20 years, and then helping you build a business plan to help you accomplish, regardless of what you're investing in, help you accomplish your end result. And that could be a combination of your real estate, direct real estate investments, public market stocks and bonds, and an assortment of private equity, one of which could be Rev Royalty. So again, call me, book the consultation, send me an email, peter@peterkinch.com. And ladies and gentlemen, in closing, I want to thank you for joining us tonight. Graham, thank you very much. It was great having you on the line. And I hope everyone has a great evening. If you have any more questions, please don't hesitate to give me a call.
Thanks Peter.
And have a great night.